Okay, hi everyone. This is going to be sort of the summary lecture for chapter 15. What are we looking at here, right? This is really choice of entity, right? You can think of it the functional equivalent of, hey, you are a tax accountant at a CPA firm. A client walks in off the street. They kind of tell you their tale. Here's my background. Here's what's going on. Can you please help me determine what are the tax consequences? What do I need to do? Right. And your clients, some of them are more knowledgeable than others, right? Some have already kind of taken some steps and done some due diligence. Others are coming because somebody told them they got to file a tax return, right? So you can get a wide variety, a wide spectrum there. This chapter is kind of meant to give you a framework for thinking about and analyzing when a client comes in. Now, one of the things is if you're looking at the optional kind of problems and multiple choice questions, I'm not really in love with a lot of those. The reason being is they presuppose prior knowledge and things that we're going to cover later in the class. So in this chapter, you may see a lot of giant equations and formulas. That's like typical textbook publisher, right? Like testing things before they teach it. But we're going to keep it high level and, like I said, reasonable in light of the discussion and what you need to know. All right, so starting here, right? You got to keep your world separate. What I mean by that is there's a legal world and a tax world. These are separate worlds. How something is structured legally is not necessarily, it can be, but it's not necessarily how it's going to be taxed, right? So let's talk a little bit about the legal structure. So this is kind of a throwback to your biz law days, right? And if you're taking the CPA exam, you'll see this stuff on the reg exam, right? The reg exam is like biz law and tax. So yeah, totally testable. So legal classification, right? When you have a business from a legal standpoint, you can have a legal corporation, a limited liability company, a partnership, right? Internal to that, there's kind of sub-classifications. There's a general partnership, a limited partnership, even more specific, like limited liability partnerships. And then you can have, on top of those, or in distinction, a sole proprietorship, like a one-man show. Now, when we're talking about all of these legal entities, right, you got to keep all the terms straight. They sound similar, but they are different in the terminology. So when you're talking about a corporation, this is a separate legal entity, right? It can enter into contracts, it can sue, it can be sued. It's like a fiction entity, right? A legal entity. Who are the owners? The shareholders. What do you do to file and create a corporation? Well, hey, you got to connect with the state and file the articles of incorporation. Okay, so there's like formalities to creating a corporation. Next, an LLC, right? A limited liability company, right? It's not a limited liability corporation, it's a limited liability company. Again, this is a separate legal entity from its owners. The articles of organization are what you have to file with the state, so there is formality. And the owners of an LLC are known as members. Okay. When we talk about partnerships, right, the owners of a partnership are partners. And when you're really talking about from a legal standpoint, right, the legal definition of a partnership is when two people or more come together and engage in an activity for profit, right? So, hey, you go on the side of the street and you're just hold up a sign, hey, we're hand washing cars today. We're going to kind of continue to run this business. That's partnership, right? That would be a general partnership. And the ideal with a partnership is it can be informal, just two people coming together, or it can be a lot more formal, like, hey, we're going to create and file something with the state. We're going to have a partnership agreement, right? It depends on the type of partnership you want. But the partnership itself, again, is a separate legal entity. And one type of partnership, right, so is a limited partnership. So you have a general partnership where each of the partners are general partners, and they're going to have joint and several liability, meaning they can come after them for their house, their car, if something goes on with the business. Whereas in a limited partnership, you have two types of partners, namely the general partners again, and then limited partners. The limited partners can only lose up to their investment. So it's almost like they're the functional equivalent of a shareholder. All right, so again, if you have a limited partnership, you have to file a certificate of limited partnership with the state. Finally, here we have a sole proprietorship. This is like a one-man show. The owner and the business are generally going to be one and the same. All right, so when we talk about sort of liability, right, if you are a shareholder in a C Corp or a member in an LLC, the business itself is going to be liable for the debts. The most you can lose is like your investment, like whatever your kind of stock basis is. For partnerships, as we've indicated, it depends on what type of partnership you have and what type of partner you are. If it's a general partnership, right, then there's only general partners, and each of those partners are jointly and severally liable for the debts of the business. Hey, the other guy screwed up and caused a bunch of damage; they can come after you. It's joint and several liability. In distinction, as we've indicated in a limited partnership, there's two types of partners, right? General partners who are personally liable, and limited partners, as we've indicated, can only lose up to their investment. So they're kind of like shareholders. When we're talking about a sole proprietor, right, a one-man show, they're going to be generally personally liable, right? They can form an LLC. We'll talk about LLCs, the different setups and kind of configuration of it. But let's kind of keep moving along here. So obviously, everything with, and when you're talking about like a legal standpoint, it's like facts and circumstances, state law specific, right? A very common thing if you go talk to an attorney, if you kind of tell them your story, they're going to say, it depends, right? Well, one of the main things it depends on when we're talking about corporations, business entities, legal entities, is the state you practice in, right? The state you want to have your business in, you're operating in, because each state has its own rules. As a general framework, if we're talking about corporations, right, normally states provide rules and procedures for creating the bylaws, like how the corporation is going to run. They say, hey, you got to have a board of directors, you got to issue shares, you have to have certain annual filing requirements with the state. Hey, pay state income taxes from the corporate level, right? So like you have the 1120 at the Fed level, but guess what? You got to do a state corporation income tax return as well. Likewise, if we're talking about LLCs and partnerships, right, they're going to have kind of state rules they're subject to as well. And finally, on the back end, do be aware of this term going public, right? What does that mean, having an IPO, an initial public offering? This can be with any type of business, but it's normally associated with like a C Corp, right? By way of example, maybe 15 years ago, Facebook went from being privately owned to publicly owned, right? Selling shares for the first time. They went public. They had an IPO. It cuts both ways in the sense, right? You can have a publicly traded company go private, right? Like Twitter, this happened, relatively recently. It was publicly traded, then it went private. Elon Musk bought it out. Okay, so this is just kind of telling you some of those legal items, right? So if that guy comes in off the street, you may be able to, like at a high level, let him know about some of these things, but obviously you can't practice law. You're not an attorney. But this is good knowledge to have as a starting point. Next, right, once and kind of as we've established, the legal framework, we got to talk about our tax world, right? And in the tax world, right, that's separate from the legal world. What you are in the legal world is not necessarily what you are in the tax world. It can be, but it's not, right? You can, by way of example, be a legal partnership, but taxed as a C Corp. That's totally possible. Likewise, you could be a legal partnership and taxed as a partnership, right? It's the default normally. It kind of crosses over like that, but they are separate. They don't like combine, and it's always going to be that way. So when we're talking about tax, right, at kind of a high level, you kind of have two setups, right? You can have separate taxation, right, where there's like double taxation, right? So you have like a C Corp, right? So the C is going to pay tax one, right? If we have like $100,000 of income, right, they pay tax on it, whatever's left over and they push out to the shareholders as a dividend, right, they'll pay tax on that dividend, right? So the idea with this is by the time it reaches the shareholder, the owner, it's taxed twice. Whereas in distinction, right, when we have flow-through taxation, traditionally things that are taxed as a partnership or an S corp, which we'll talk about. The idea with this is, hey, if we have a partnership, right, that triangle, and there's 100 grand, the partnership doesn't pay any tax on it, right? Instead, they push out K1s to all the owners, and the owners are going to pay the tax, right? So there's only one layer of tax. And it's not always better that it's a partnership or S corp, right? You may think like, oh, double tax, you should always do that. Like, yeah, a lot of times it does make sense, but there's other situations where a C corp makes sense, right? Once you think about sort of those legal characteristics, maybe you don't want to be a partnership, right? Maybe you don't want that unlimited liability as a general partner. Regardless, right, now that we know that we have our legal world and our tax world, you got to be aware of kind of the connector between them, right? These check the box regulations. And basically these rules, the check the box rules, they tell us default configurations, right? If you are this in legal world, then you will default to that in tax world. And then they say, if you want to depart from that default configuration, you can check the box and be taxed another way, right? So by way of an example, and as we've said before, a legal partnership is going to default to be taxed as a partnership. However, it can check the box and be taxed as a C Corp and file an 1120. Right, so this is the check the box form where you would make that election. So what are the default rules? And let me kind of find the setup here, right? So this is what's going on, right? We have our legal world, and then we have our tax world. The check the box rules are the bridge, right? They connect it. And they provide default rules, right? You can think of it like playing a video game, right? If you've ever opened up a video game, maybe the default rules or the setup is it's on easy, right? So this says, hey, here's a default rule. We have legal entity X. It's going to receive Y taxation, right? We have a partnership. It's going to receive partnership taxation. However, right, you can change the rules, right? You're at easy, hey, you want to play this on hard mode, right? Well, then you can check the box and say, hey, we have a legal partnership that wants to be taxed as a C Corp, right? Now, they do let you generally mix and match, but you can't always cross over right on it. So like certain things can't always like pick whatever they want to be taxed. There are kind of limitations to it, but I'm just explaining kind of the high level what's going on here. So let's talk about those default rules, right? The check the box rules, the default, right? This is like you open up your video game, it defaults to this. So this says, hey, if you have a legal C Corp, it's going to default to C Corp taxation, right? You're going to file an 1120. One thing to be aware of, though, right, is that once you have the tax status of a C, you can make an election to be taxed as an S, right? So you're going from basically the 1120 to the 1120S. And what's the difference here, right? I mean, both of them, right? SC Corp, S Corporation, aren't they both corporations? Well, we got to keep our framework straight. Are we talking about legal world or tax world? From a tax perspective, an entity taxed as a C can make a subsequent election, right? This isn't check the box. This is almost like on top of checking the box to be taxed as an S. And C and S refers to like the IRS code, like subchapter C, subchapter S, that gives the rules on these. It doesn't really mean anything beyond that. But essentially what's going on here is when you have the C, right, you have the two layers of tax. When you have the S, right, that's going to be a pass-through entity, right? So you're going from like sort of one framework to the next, right? And there's different criteria with S corps, right? There's like a chapter in the book. We're not going to cover it as much in this class. It's more of there's like a separate class on like flow throughs and things like that, or separate chapters if we get to those. But that's the idea here. And one thing to be aware of, right, is whenever we talk about an S corp, right, this is purely a tax status, right? There's no such thing as a legal S corp, right? In legal world, this is something totally different. All we mean is when we say S corp is that it's a pass-through entity. It's an item or a business that's taxed as a C that chooses to be taxed as an S, assuming they meet certain rules. Okay. All right. So corporations, right? They are incorporated, right? That makes sense. So kind of as if we're defining this in the negative, anything that isn't a C has to be unincorporated, right? So a sole proprietor is unincorporated. A partnership, general partnership, an LLC is unincorporated, right? It's not limited liability corporation, it's limited liability company. So we just said here, kind of rehashing, default configuration for a C. If you have a legal entity that's a C, it's going to be taxed as a C. Once you're taxed as a C, though, you can make an election to be taxed as an S. All right, so moving on here, let's talk about the other default rules, right? What you default to. So unincorporated entities, what we just talked about on the last page, right, with one owner. So for example, a sole proprietor or a single member LLC, they are going to default to sole proprietor, Form 1040 Schedule C, right? Schedule C. So hey, you are a one-man show, you paint houses, you cut grass, you're going to throw that on your Schedule C, your income and expenses, you're going to get hit with SE tax on it. Likewise, unincorporated entities with two or more owners, right? So a partnership or a multi-member LLC default to partnership taxation, right? They're going to file a 1065, right? So this is where I said, like, if you have a legal partnership, it's going to default to partnership taxation status. Now, let's take a second here to talk about LLCs, right? Because we see these little acronyms. What do they mean here, right? When we have an LLC, this is the opposite of an S corp in the sense that it is purely a legal status that is never a tax status. There's no such thing as an LLC tax form, right? What you have to look and see is my LLC a single member LLC, right? There's like one owner, or is it a multi-member LLC, right? There's multiple owners, multiple members, right? If you look at the rules down here, right, if you have a single member LLC, hey, maybe you're painting those houses, right, and you throw it on your Schedule C, but you want more legal protection, right, because, sole proprietor, you're going to get sued, you're personally liable. An LLC, the most you can lose is your investment. We said here, the default configuration is a Schedule C. For a multi-member LLC, right, it's 1065, right? So it's Schedule C on the 1040 and the partnership taxation status for a multi-member LLC. Now, this we just looked at, but let's kind of see, right, if we do a thought experiment, this is kind of building off what we said. How do you get from in your legal world, right, purely a legal status all the way to being taxed as an S, purely a tax status, right? And if we're talking about an LLC, how this might work, right? So say you have a single member LLC, just you, right? We said, hey, the default, the general rule is going to be you're put it on Schedule C, but you can check the box to depart from that and say, hey, I want to be taxed as a C. On top of that, right, once you get the tax status as a C, then you can go really wild and almost kind of do like a double checking of the box. It's a separate form you fill out, but then you can get to the S, right? So how does it work, right? You get a one-man show who's filing an 1120S. On the flip side, right, if you have a multi-member LLC, right, the general rule for them is going to be partnership taxation. They can check to be taxed as a C, go crazy, and then double check to be taxed as an S. Right, so what's the upshot of this? Why do you care about this? Well, if you're going into tax, right, it's very common that you're going to do an 1120S, right, a flow-through tax return. A lot of people don't realize, right, kind of this underlying structure of what's going on. Most of the time when you have the 1120S, right, normally what's going on underneath it, yeah, this is tax, it's flow through, but a lot of times it's a legal LLC or it's a legal partnership, or it could be a C Corp, right? So you kind of have to do and think about anytime you're doing an S Corp return, what's going on here, right? What is the kind of underlying framework? So here's a little visual, right, to help show you these things. I'm going to do just another slide or two, kind of unpack this a little bit, and then we're about halfway through the deck here. So taxation of business entity income, right? So we said you have flow-through income, right, where there's one layer of tax. And then you have the double layer of taxation if you're a corporation, okay? Flow through is taxed once. The income is treated as constructively as if it flows through to the owners at the end of the year, regardless of whether the income is distributed to the owner. Right, so what's that saying? Right, we have a 1065, or we have an 1120S, right, partnership or S Corp return. They have 100 grand of income. Right, they have to kind of dish that out to the owners on the K1, right? Each one of them are going to get a K1, and the tax is paid at that level, right? And you know, if you learn about the other things, right, partnerships have a little bit more flexibility because they can have special allocations, whereas S corps have to be like pro rata, like how you kind of beat this stuff out. It has to be based on ownership interest, but that's the idea there with it. What's like a very common thing, right? Well, if you make 100 grand, right, if the business makes 100 grand and you get a K1 showing, hey, I have ordinary business income of 25 grand, at the owner level, you got to pay tax on that, even if they didn't give you a penny of the income, right? It's almost like a form of accrual accounting in the sense that you don't count if you're an owner in a flow through of when you get the cash itself as income. It's whenever the business earns it, like, sort of like, you know, they push it out to you on the K1. So yeah, you can get this K1 with 25 grand, but they better push out a distribution to use some cash to help pay that. And when they push out the distribution, that's going to reduce your basis, like your stock basis in it as a general rule. Here, right, it says C, it's taxed twice, right, to the C at 21%, and then to the owners when it distributes the income as a dividend. So let's pull up a quick example here. 15.1. So you can read those, but what's going on here? Right, if we look at this, TP1 forms a corporation. They file the articles of incorporation. What are the filing options, right? Well, we have the default C Corp. However, they can elect to be taxed as an S, right? Go from that double taxation to the flow-through taxation. Here they change the facts, except they form a C as a single member LLC, right? So when you have that single member LLC, right, if we look over here, right, assume Nicole and CCS are not secret entities. What are her options for classing CCS for tax purposes if she's the only owner? Okay, so this one says sole proprietor if she's the only owner. Assume she legally formed CCS as an LLC, right? So that's what we're looking at in this one, right? So if it's a single member LLC, in the first example, right, the default is going to be sole proprietorship, right? So, hey, it's just her, right? She's going to open the business single member LLC. We're looking at the 1040, Schedule C. However, right, she can elect, check the box to be taxed as a C, and then make that double check if she wants to go to the S. Finally, in the third example here, right, they say same facts as above, except she forms it as a multi-member LLC. So maybe there's other owners. Well, hey, the default there is going to be partnership taxation status. So again, this is just kind of showing you the setup here. We will talk in the next lecture about these shapes, right? Like why a corporation is a rectangle or a partnership is a triangle. This is important in practice if you look at like org charts and stuff like that. But this is just showing you kind of a summary there of those items. And let me see here. So we're about halfway through this deck. So I'm going to pause it here in the lecture and we'll pick it up on the second half. I like to keep these about a half hour. So this one's a little bit shorter, which is fine. Going to be about in 27, 28 minutes. So with that, I'll end it here and we'll see you in the second lecture.